Morning seminar, which is about key changes to UK GAAP and in particular changes to FRS 102. Throughout this session, we will be going through a high-level look at the key changes, but also be focusing on implementation, and I'll be covering some implementation stories and things to consider. But the objective of the session is to keep it quite practical and not too technically involved. This is just our standard firm's disclaimer, which I will not read out. This is a CPD course, so we will provide 1 hour of relevant CPD, and you can use the feedback form to request a CPD certificate accordingly. And yes, this webinar will be recorded, and therefore you will be able to access this webinar in the future to refer to again. Just remind everybody to sort of keep microphones muted and switch your cameras off. There is a Q&A session later, and I'll try and do my best to answer as many questions as possible. But where it isn't possible to answer all of the questions, we will collate those and get back to you. So, what will we be covering this morning? Firstly, I will introduce myself. My name's Neil Parsons. I head MHA's financial reporting technical team, and I get involved in quite a lot of client project implementation work. So I've had experience in the past of implementing a lot of these requirements in the IFRS world with clients of various sizes, and I've done quite a lot of training on these important amendments to FRS 102, and I've been doing some project work with clients and teams across MHA. So that's me. A brief overview of the session. I will cover in a diagrammatic form, and I'll try not to frighten people with that. The first deeper session will be regarding revenue from contracts with customers, and the second session will be on accounting for leases in the financial statements of lessees, and those are the two biggest changes to FRS 102 that we're going to experience. Then we'll sort of break for a quick survey of a few questions, and then I'll cover some of the other important changes to FRS 102 which do likely get forgotten about, a refocus on the transition timeline, and then a session which deals with practical implementation considerations, hopefully leading into the Q&A, and hopefully you'll be able to ask any questions that you may have. Fingers crossed I'll be able to answer them. So, an overview of the session. I'll go straight into the transition diagram. Now, we have changes to FRS 102. The FRC did a detailed review of FRS 102, and the key headline is that they decided that they wanted to implement similar requirements to IFRS for the accounting of revenue with contracts with customers, and also to bring in the lease accounting model for lessees, bringing most leases on balance sheet. That's the key headlines, but the project doesn't really start there. For this year, and for accounting periods commencing on or after the 1st of January 2025, the first amendment to FRS 102 relates to a set of financial instruments known as supplier finance arrangements, and these are where a company might arrange a specific finance facility through a bank, which allows its smaller suppliers to get payment earlier than what the normal payment terms are offered by the entity in question. And this is an amendment to FRS 102 which covers disclosures. So it requires disclosure of the existence of these balances and the impact of the balances on cash flows of the entity and when balances might be settled, when they're outstanding, and payments and terms and conditions. And if people want to know why this amendment is being put into place, it is effectively because of what happened with the collapse of Carillion. Carillion had a huge supplier finance arrangement where their small suppliers could get paid early through a bank, and then Carillion at a later date would pay the bank all of those amounts that had been forwarded to their suppliers. But this facility was absolutely huge, a £1 billion facility, but it was barely disclosed in the financial statements, and its existence was only really proven following the collapse. So the objective of that amendment is to bring into fruition the existence of these arrangements. And not all companies enter into them, but particularly larger entities and a lot of entities in the contracting and construction centre with lots of small suppliers might enter into these arrangements. So that's something to be careful of. But the big changes are for accounting periods commencing on or after the 1st of January 2026. And those changes include the changes to revenue from contracts with customers, the lease amendments, and some other amendments, which I'll come on to a little later. Now, if anybody is wishing to make all of those amendments early, and I'm not aware of anybody that's really looking to early implement any of these changes, then if early implementation is proposed, then all of the changes must be adopted together, and that's absolutely all of the changes. So the Financial Reporting Council do not want us to cherry pick changes, but we will come on to this transition diagram a little later, but I thought it'd be good to sort of prime it up front. So with revenue from contracts with customers, let's dive into this. And really, the title is quite critical because the amendments to revenue recognition under FRS 102 particularly does relate to contracts with customers. We're not thinking about changes to, interest income or dividend income, things like that. These are particular contracts with customers. And many of you will probably have heard of the changes, but where that is the case or where it is new, this recap should facilitate information for those that are new to this or are relatively familiar. So what the Financial Reporting Council is doing is applying the concepts that are based upon IFRS and IFRS 15. So the Financial Reporting Council is introducing a comprehensive 5-step model which is intended to be applied to all revenue contracts with customers. So whether those contracts are for the sale of goods, for the provision of services, building work, building machinery, building vehicles, performing audits of financial statements, performing advisory work, legal, professional fees, all sorts of things. All of these principles are intended to be consistent, and the intention is that the principles are intended to account for the actual contract which is in place with customers. So the focus is on the contract with the customer, whereas historically and at the moment under UK GAAP and old IFRS, we were used to just dealing with revenue recognition as a concept of dealing with a transaction and how to account for a transaction. So the current version of FRS 102 has one or two principles for the sale of goods, provision of services, and for construction contracts, i.e. building major assets for customers. But with those concepts, it's really sort of supported by a number of worked examples, which somehow manages to hold things together. This is totally fundamentally different, and we're introducing new terminology and a particular way of approaching the accounting. It's almost like the accounting standards are telling us what to do and how to behave and how to approach a transaction. The amendments for this are extensively detailed, and you know, they increase the volume of the FRS 102 literature quite extensively. So the chapter dealing with revenue recognition is very big. It's got requirements, then it's got application guidance, and it's not perfectly a copy and paste of the IFRS requirements, but it's particularly close. And not forgetting, in terms of disclosures, the disclosure requirements are a lot more enhanced and actually look at the balance sheet perspective of revenue in the form of things like contract assets and contract liabilities, which we will come on to a little later. So this 5-step revenue recognition model, and I'll always say up front that for those whose financial statements are audited and you know, eventually will be preparing for an audit, an auditor would expect you to have gone through all of the 5 stages of the model in order to demonstrate that, you know, you've implemented this standard appropriately. It's often asserted that, you know, the revenue recognition is the most fundamental part of the financial statements. Getting that wrong means most of the areas of the financial statements may be incorrect. So you know, in terms of providing papers for auditors, the 5-stage model is first and foremost a central feature. So step 1, and this is identifying the contract or contracts with the customer, and you know, these contracts would be, you know, those contracts which are enforceable agreements between the entity and the customer, you know, enforceable under law, whether written, implied, supported by legislation. Often, you know, you do have contractual arrangements with the customer, but it's important to identify all of the contracts, and a single deliverable might be in the form of a number of contracts. For example, there might be a master contract, a subcontract, and side contract and side agreement. It's important to ensure that we do capture the complete contractual form of the arrangement which we're looking to account for. And step 2 is looking through that contract and identifying what we now describe as separate performance obligations. And in simple terms, a performance obligation might be a promise to provide goods to the customer. It might be a promise to provide a particular service, to construct a piece of property, and so on and so forth. So identifying each of the separate performance obligations is the next fundamental step. And the third step in the contract is to determine, you know, the transaction price involving the contract, and that forms what is the right to consideration, the right that the entity has to receive as and when those performance obligations are satisfied, or as those performance obligations are satisfied. And the fourth step is allocating the transaction price to the previously identified performance obligation. So it's a set of logical steps which in some certain circumstances, for example retail or simple sale of goods, might be pretty straightforward. But in terms of if we're doing a a construction contract for building services and building maintenance software, various things, various multiple deliverables, these steps can be more difficult. And, the transaction price itself might be a fixed amount of consideration, or it might be a variable amount of consideration. So there is particular requirements in order to be clear of, so that we're both identifying and correctly allocating the transaction price to the right aspect of the performance obligations. And then essentially once all of the other steps are taken, we're recognizing revenue when, for example, at a point in time, when control of a service or a good is passed to a customer, or we're recognizing revenue over time as an entity satisfies its performance obligations, for example, because it has a right to consideration as services are performed, and the control of those services sort of takes place over a period of time. So the customer, for example, owns the output. And I do have to apologise for some of the terminology, because that is the level of terminology that is used. And the key challenges and judgments involved is, as I explained before, demonstrating to auditors and to other key persons and stakeholders, demonstrating that the concepts of revenue recognition under the new requirements have been applied to your population of revenue contracts, and understanding and applying the new terminology, and being sort of more comfortable with it. This terminology is designed for use all around the world. It's based on IFRS. The FRC haven't really changed any terminology to make it UK specific. And it is really, identifying and accounting for also the costs involved in obtaining, for example, winning a contract and also fulfilling and completing a contract. It's not just about revenue, and some people are shocked at some of the level of detail involved, that might actually sort of think, well, we need to look at all of these contract costs. We need to look at how we're accounting for costs and what we're doing in that particular area. So it's not just purely about top line revenue. And, the key challenges are identifying a concept known as distinct goods and services. So a distinct good is something that's, delivered separately, and something is distinct if it's sort of effectively more on a standalone basis. And goods that aren't distinct, there might be goods that are supplied, but they all rely upon each other. Those types of goods are sort of accounted together, or those services accounted together. So it really is trying to sort of take that contract, tear it apart, depict it, identify the performance conditions, identify the consideration, and allocate to each of those bits of the contract, and account for each bit of the contract separately, or where there's no distinct goods or services, account for the contract as a whole. And more key challenges are, identifying contracts that where they're performed either at a point in time or over a period of time. And one of the best examples is where, for example, a software company might provide access to intellectual property in the form of a software license, but that software license is just based upon the functionality and condition of the software when you buy it effectively. So you buy a software license and you get to use the software and take it away, but that software is never updated, it's sort of as is. Well, that's sort of, in a sense, recognizing a product revenue at a point in time. But then in the real world, a lot of these software services now continually update the software over time. So you might have an agreement to use a piece of software for 3 years, but the intellectual property underlying that software might be changing and improving over time with different abilities added or improvements or new functionality. And that is really like more of a continual service. So that type of service is recognized over time. So what we're doing is sort of thinking about concepts slightly separately. We're not thinking about, oh, we're providing services and we're recognizing services as the service is consumed. We're looking at the manner of delivery of the services and how we perform for our customers and how we depict our performance to customers. Variable consideration is a deeper concept. We're all familiar with contracts for variable consideration, but we may not think of things like termination bonuses if a contract was terminated early, or a contract penalty as variable consideration, or performance bonuses for completing a contract, or volume rebates and things like that for customer contracts. These are all concepts of variable consideration, and also like contingent consideration. So there's a lot of separate analysis there, and we generally recognise variable consideration where there'll be a high probability that there won't be a reversal of that consideration once recognised, and there's more than one accounting policy choice for dealing with that. We can recognise revenue on the most likely outcome or an expected weighted outcome. And one of the big changes here is modifications to contracts. So the terms and conditions of a contract might be modified. The price might be amended over the contract. We might add or amend performance conditions in a contract. Current requirements do not include anything to do with such modifications. So these have just been formed just based on best estimates, and there may be differing ways that entities have approached modified contracts historically. So there is a consistent set of requirements there to consider. And the continued challenges, which are further highlighted by what I describe as the deeper guidance in the standard, are, combining and separating contracts, as I mentioned earlier. It's a deep analysis of the contracts. The concept of bundling and unbundling, it does exist, albeit the standard doesn't describe that, but this is identifying distinct services and whether those are accounted for separately, or whether services are not distinct and they operate together, so are accounted together. The accounting for the stage of completion of the contract, input methods versus output methods. So if we're recognising income over time, an output method might be sort of valuing the work done to date. Input methods are generally sort of methods where we identify like the level of work performed internally, and that can be based on time and materials and costs. So there is detailed guidance regarding the stage of completion. It's just mentioned in a few sentences in the current version of FRS 102. We have much deeper guidance of the merits and drawbacks of these different methods, and in the revised requirements, and pros and cons of each one. So we are getting deeper into the theoreticals here. Also re-estimating contract revenues and revisiting the stage of completion on changing estimates. This is an area which isn't really covered in the current guidance, but it's a little bit deeper now in the new guidance where, are we re-estimating contracts or are we actually looking at a modified contract, and deeper principles into contingent revenues, and also principal versus agent considerations, i.e. whether we're recognising revenue gross or whether we should be recognising revenue net. And I do believe that, a lot of what we do and a lot of what we're doing at the moment, we will sort of need to revisit and re-establish and write papers. And some of my implementation experiences are, one might expect that, in the construction industry that there are some big changes afoot, but actually when you do go back and look at the implementation of IFRS 15 and look at some of the financial statements of the big building developers, it's not really the revenue that changed a lot. Some of the cost recognition changed, but there didn't seem to be a huge impact on profit. But the big changes appeared on balance sheet. For example, specific separate disclosures for contract assets. For example, those are the types of assets where work has been performed and we've got the right to income, but we haven't billed the income yet. So we record a contract asset and credit revenue for our right to consideration, and also contract liabilities, where we may have received money from our customer in advance of actually providing the service or the good, i.e. Before fulfilling the performance obligation, and contract liabilities, in effect, deferred income. And, the disclosures accompanying the amendments look at the movements of contract assets and contract liabilities and age contract liabilities in terms of where, when and how those liabilities are going to turn into performance obligations, and then accordingly when revenue will be recognised. And also re-looking at the costs of obtaining a contract and what costs are required to be capitalised. For example, the incremental costs of winning a contract, also contract fulfillment costs, and those are the costs that relate to the fulfillment of the overall contract. And costs of obtaining a contract and fulfilling a contract are sort of capitalised as costs and are amortised over the duration of the contract. Key never to take a shortcut approach. We really do need to assess the complete 5 stages and can assess all of our contracts. So it is about having a high level of time involved in understanding and demonstrating that that we've done a full and complete exercise, and sort of building our implementation around the required disclosures. So if we're developing new systems in order to account for revenue, we're actually upfront building in the necessary disclosure requirements so that our systems make things a little easier for us. So it's not necessarily just a case of just putting loads of sales contracts in the sales office in a folder. Now it's all about having a really good level of organisation over the entirety of the documentation that supports our revenue transactions. So moving on to the accounting for leases in the financial statements of lessees. And this is one of the really sort of big changes that took place in IFRS around about 2019, and the FRC have decided that it's right to implement into UK GAAP and FRS 102. And a recap of this, that it's a new accounting model introduced to bring most leases onto the balance sheet, and some leases which don't go on balance sheet are short-term leases of a duration of less than 12 months, and leases of low value underlying assets. So for lessees, the critical distinction between operating lease versus finance lease with the former being off balance sheet and the latter being on balance sheet, that is now removed. So for lessees, we do not think about operating and finance leases anymore. We're thinking about what leases are on balance sheet and what leases are off balance sheet. And I keep talking about the balance sheet, but it is very important to think about the impact on profit of bringing these leases on balance sheet. It's not just a balance sheet issue. And also there is, again, a challenge in collating the necessary disclosures, which I will come on to. So, and this is going to be a very quick high-level overview. We're bringing on an asset on the balance sheet, and that asset is the right of use asset. So it is the right to use an underlying asset. It is not the underlying asset itself. It's not the physical asset. It is our contractual right to use that asset over the term of the lease. And our right of use asset is generally measured as follows. We calculate the lease liability, which is going to be put on the balance sheet as the present value of the future lease payments, which I'll come on to later. We add on to that any lease payments that have been made before the commencement date of the lease, less any lease incentives that have been received. We add to the asset the initial direct costs incurred in obtaining the lease, and also we add an estimate of the discounted future costs of decommissioning or restoration in respect of that asset when the lease ends. So that is the right of use asset, and that right of use asset is depreciated over the shorter of the lease term and the useful life of the underlying asset. And that leased asset may also be subject to impairment losses, and also that leased asset might be adjusted in future if there are needs to remeasure the lease liability, or if there have been certain modifications to the leases. Now, this session will not go into the details behind lease modifications. And our lease liability is the present value of lease payments, but not all lease payments. And that present value of lease payments attracts interest, and interest is charged at a constant rate over the carrying amount of the lease liability, and the lease liability reduces as lease payments are made. And as in the case of the right of use assets, there may be remeasurements of the lease liability and modifications which require a change to the lease liability over time. So we then get the closing lease liability. And whilst that is an overview of bringing a right of use asset and a lease liability onto the balance sheet, we do have key judgments which we need to consider. And in the appendix to this presentation, I have included various definitions of the lease and the lease term. It is important to ensure that when we're doing a project to account for leases under these new requirements, that we clearly understand the definition of a lease and what that means, because we need a specified right of use asset, which we have the right to use for a period of time in exchange for consideration. And if we don't have a specified asset, we don't have a lease, we have a service instead. And the lease term can be a variable number, and it requires judgment. So the lease term is any minimum lease term as adjusted for any additional terms where we are reasonably certain of extending the term, or we're reasonably certain of cancelling the term early. And those reassessments might change over time. So the lease term and the lease are fundamental. We've got to identify the correct types of transaction in the first place if we're bringing them on balance sheet, and the lease term and the likelihood of extension or termination of options affects the lease term because that is discounted and against the level of payments made. So if we get the lease term wrong, we get the lease liabilities wrong. And also when we're discounting the lease liabilities, we have to identify an appropriate discount rate, and there is more than one discount rate which is available. For example, if we have the rate implicit in the lease, then we must use that discount rate. Otherwise, in FRS 182, if we cannot readily determine the rate implicit in a lease, then we would use the incremental borrowing rate or an obtainable borrowing rate, and I'll come on to those a little later when I just have a quick look through the appendix. And also in this, we're distinguishing variable lease payments because it's only variable lease payments that depend on an interest rate or an index that are included as part of the lease payments. So, for example, other variable lease payments, for example, turnover-based rentals and excess mileage that do not relate to the future use of an asset are excluded. So variable lease payments are expensed as incurred. And implementation experiences here is that, it's really important not to just dive in at the deep end. First project I was involved in was disastrous. It was a client that wanted a fast solution, and they wanted to go through things, and they threw lots of lease information at me, and it was a case of trial and error and trying to build something as we went along. And what was sort of delivered after a first couple of weeks was a frustrating set of spreadsheets which had got lots of incomplete information, and it became quickly evident that the client needed to go away and do quite a lot of background work before even getting close to the calculations. So and so really it is important to do things really logically, and it's not just the balance sheet effect. The impact on profit or loss is important because for operating leases we get a constant expense generally at the moment. Where we bring in leases onto balance sheet, we'll have a constant expense for depreciation, but the interest will be higher in the earlier periods. So we will have a skewed overall lease cost, which is higher in the earlier periods and lower towards the end. And that has a positive effect on EBITDA overall, because what happens is that depreciation and lease interest get removed from the EBITDA calculation, obviously, which at the moment EBITDA calculations reflect the operating cost of leases as an expense, and so the profit effect overall, the net profit effect may be lower profits in the early years of a lease and higher profits in the later periods of a lease. So we've really got to ensure that we understand that and speak to our stakeholders about those issues. So a lease accounting implementation plan is, and the way that this is the way I've approached it in the past is, firstly identifying the leases, making sure we've got the correct population of leases, and we've done a complete population test of leases in accordance with the definition, and then we're absolutely capturing all of the lease data somehow, and ensuring that everything is complete. Then we're classifying those leases into those leases which will be on or off balance sheet, or variable leases, low value leases, short-term leases, for example. and measuring the leases. So only when we've got all of the information and we know what we're doing with the leases do we even start doing the calculations. And this is the bit where we would identify the relevant discount rates, and don't assume that we can just identify one discount rate and use that for all of our leases for all of the years. The discount rate is something that every time we get a new lease, we will need to sort of look at the discount rate. And, leases of different duration might have different discount rates as well. So it's not just a single number. And it's so important not to reinvent the wheel every year. Opt for a sustainable solution when we're doing the lease accounting implementation. We never want to get buried in spreadsheet after spreadsheet, and Excel might not be the best answer. And then go back to the start and repeat. So we end up with a set of embedded processes so that we can just have an ongoing management of our leases with good information that we can sort of sustain and redevelop every year. So we do not have like a really difficult time every single year. We might take the pain in the first year of implementation, but hopefully after that it is really just routine maintenance and our systems are ready and capturing leases and we're doing things. And it may be the case that we're not necessarily putting the lease calculations into our management accounts. We might be just doing them in our statutory accounts, but these are the things that need to be considered when we're looking at the implementation plan, and we'll come on to a lot of the other practical considerations later. So now we have time for a survey, and hopefully you can answer some of the questions that may arise. And this is the bit where I might need a little help, Emma, I think.
Hi, Neil. The responses are coming in at the moment.
Okay.
So I can give you a overview of where they are at the moment. Just to clarify that not everybody will have access to the polls. It depends on which device you're accessing it from. But for the first question, when did you or do you plan to start your FRS 102 implementation project? 22% have already started, 21% late 2025, 41% for the first half of 2026, 13% for the second half of next year, and then 4% looking for the first half of 2027. How will you run your implementation project? We've got 54% planning in-house, 8% with external advisors, and 37% choosing a mix of the two. For question 3, do you plan to upgrade accounting systems to comply with the new requirements? We have 9% yes, 72% no, and 19% maybe. Will you be using AI tools to assist in project implementation? We have 9% for yes, 44% for no, and 46% maybe. And the last question, what level of external implementation costs do you anticipate incurring? 75% less than 5,000, 19% between 5,001 and £10,000, 2% between 10,000 and 20,000, and 3% above 20,000. We've had 220 responses so far, but this poll question will remain live throughout the rest of the webinar, so people can revisit the responses to that afterwards.
That's brilliant. That's brilliant and interesting information. And I do wonder that over time whether some of those answers might change. And the one that interests me a lot is the idea of whether special software might be needed for leases or whether we intend to rely upon Excel. And I think that depends on the number of leases that we have and the level of complexity. I've been involved with Excel models, and the one Excel model that still gives me nightmares is one which was built for about 200 odd leases, and it used to take 3 hours to fire up. And when I was firing it up for the client, I had time to sort of leave the office in Birmingham, get the train home, have my tea, and then the computer was still whirring away, and I got my fingers firmly crossed, thinking, I hope my computer doesn't crash and this works. So it's always a case of don't underestimate um, the or the lack of calculation power of Excel sometimes, and the time-consuming nature of some of the calculations that are involved. I know like technology does improve, but don't assume that your computer can handle these things really well. The AI one's interesting. I would have thought more people would be going for AI, but I suspect that as the projects are implemented, some of those answers might change. Some other important changes, and this is just a quick aid memoir, really, not to forget some of these things. It's easily done. The definition of fair value used in FRS 102 is getting aligned to IFRS, and in particular, that might not change things for fair valuing assets and financial assets, but it might have implications for the fair value of financial liabilities, because the definition of fair value will change, and it currently assesses fair value based on whether the amount at which a liability would be settled, but the amendment looks at whether the fair value of which a liability is transferred to another party. So fair value assessment of certain liabilities might be a little different, and it's quite a complex area, but I do want to flag that. Uncertain tax positions, and this is like income taxes, corporation tax, and deferred tax, bringing in the methodology in IFRS on how to calculate uncertain tax positions. For example, where you've undertaken a tax treatment that might be challenged by HMRC, and you might need to make a provision for additional tax where that tax treatment to be challenged by HMRC, and you might make a provision, for example, based on the most likely outcome of a challenge by HMRC, or an expected present value of possible outcomes. And it is quite a complex area, and it will involve clients speaking to their tax advisors and ascertaining what and understanding deep down, do we really have any uncertain tax positions? And obviously, like clients may know when they have such things, and sort of disclosures of judgments and estimates surrounding those, but not to make disclosures that are seriously, prejudicial to tax cases. Clarifications on business combination accounting, and the one that always springs to mind with me is whether consideration in a business combination is actually consideration payable to purchase a business, or actually is it instead remuneration for post-business combination services of the acquiree. Going back to lease accounting for lessors, and the existing finance lease and operating lease model for lessor accounting is largely retained, but with different terminology. But also there is deeper guidance regarding sublease accounting. So if we're leasing properties and then subleasing them out to others, there are some particular considerations to take into account, because we're not necessarily now just subleasing out the underlying asset, we're actually subleasing a right of use asset. So it's all about, do we de-recognise a right of use asset if we're subleasing that asset to others? And not forgetting smaller entities, and there will be smaller entities on this call, and it's important to note that all of these changes to revenue and lease accounting apply to small entities applying FRS 102, including Section 1A of FRS 102. So they have to do all of the debits and credits that we're talking about here, and all of the measurement changes for leases. There are no exceptions for small entities, but the disclosures just may be a little fewer. And there are other enhanced disclosures that the FRC have decided that they can mandate more disclosures, which would be necessary in order for a set of financial statements prepared using the small companies regime are required to include to show true and fair view, and that would include certain share-based payment transactions, more information on leases and revenue, and also deeper disclosures regarding the going concern status of an entity and one or two others. And implementation experiences on some of the other areas really that are being amended is really just not to forget them. You know, it's important not just to concentrate on revenue recognition leases. You know, other things might crawl out of the woodwork as well. So just have a mindful eye on other changes as well. The transition timeline, and this is an important thing in our project. So most changes to FRS 102 are done retrospectively, but for leases, we're not allowed to do retrospective application of bringing in the changes. So we do not do any prior year adjustments. So we bring the lease asset and lease liability onto balance sheet on the first day of the affected accounting period with a corresponding adjustment to retained earnings. So we're going to have a situation where our comparatives are different to our current period, but yet with revenue recognition, we have a choice of restating the comparatives so we can be consistent, or we can just opt to adopt the new requirements on the first day of the first accounting period, which the changes are effective, and that might mean that we can have revenue transactions in 2 separate years done on 2 different bases, and that is something, you know, to speak to stakeholders about. It's really important that, you know, your stakeholders understand those changes, and the board as well, and front-end disclosures may need to make up some of this difference and clarify that, you know, the current and the comparative period may not be entirely comparable, and giving the reasons and support as to why. But generally, all of the other amendments are retrospective, including uncertain tax treatments. However, the fair value amendment is prospective from the first date of application. And for supplier finance arrangements, which is due for application a year earlier, there's no requirement to disclose comparatives in the first year of making the supplier finance arrangement disclosures. So on to the final practical considerations, and a lot of these are sort of takeaways for you to read and think about. It's all about being ready. It's all about confirming, you know, the effective dates of the amendments, collation, identification, understanding systems, ensuring teams are trained, deciding on what transition methods you're going to apply where you've got choices, thinking about systems and internal controls, thinking about the changes to disclosures up front as well, because if you're going to make big changes to the way you collate information, why not think about what the disclosures are going to look like so you capture the disclosure information internally? And as I'll keep saying, continually liaise with stakeholders. And implementation projects really is like standing back and thinking deeply, having that time to think. Don't dive into the deep end, stand back, assess, and then design, you know, your solutions, and then, you know, work out implementation, and then monitor and test, and make sure that you know, things are rolled out which work, and that there aren't any unintended errors or problems that have arisen as a result of this. And it's liaising with stakeholders up front, keeping auditors informed, having somebody who's designated head of the project, and having the right people in the team. And again, it's like, the stand back assessment is thinking about accounting, the processes, the IT systems, and most importantly, the people that are doing it. Who in the business deals with the leases? Who looks after the leases? Is it somebody in the accounting team? Is it somebody from procurement? Is it a property manager? Who knows the most about property leases? Who's the best person to get involved in the project? May not be an accountant. It may be the property person who has a deep understanding of the knowledge of the systems. It might be your lawyers who are keeping all of this information for you. So it's just sort of stand back and think. And common pitfalls, it's really, don't underestimate data capture. Don't assume that all of your lease information and your revenue recognition information is at hand. Think about impact on profit, distributable reserves, bonus plans, all sorts of effects, covenants. Don't delay system setup until the very, don't delay until the very end. Think about things early. Don't treat it as a one-off project. It's a continual project with, and we want to keep it sustainable, not reinventing the wheel. Have the coherent plan. Have the right people. Plan your journey properly. Understand the requirements. Demonstrate that you're in, that you're implementing them the way the standard wishes out. Identify and manage your stakeholders, set out clear project milestones and achievable deadlines, aim for that sustainability, and fundamentally keep the board informed of progress, time, anticipated costs, actual costs, and when things are completed, or what difficulties come along the way, and what proposals are to sort of get around those. So it can be a big journey for some, not for others, but always important to make sure that we plan those things properly. And now we're into the final element of the Q&A. So
Thanks, Neil. We've had a few questions that have come in. The most popular one, based on upvotes of it, is around car leases. So the question is, if the cost of leased cars are largely passed on to employees via salary sacrifice, do we still need to account for the contract on our balance sheet, or could we deem it low value and exclude it?
I think cars are generally one of those items which aren't going to be treated as a low value underlying asset. The way that it works under IFRS is that they look at a de minimis limit, and then sort of say that cars are not an example of a low value asset when new. We don't necessarily look at the value of an asset when new. Under FRS 102, we look at the value of the asset at the time that the lease was taken out, which generally might be when a car is new. So I don't believe that a car would generally be a low value asset. And the important thing with these salary sacrifice arrangements is to assess whether actually is the company leasing the asset, or is the employee actually leasing the asset. And there are a myriad of arrangements that may be in place. So it's important to do a holistic assessment of those types of things. But that those questions do pop up, and some might say, well, it sort of depends, really. But I think the very first question is does the entity have a lease of that vehicle or not?
Okay, thank you, Neil. The next question is, what differences, if any, between FRS 102 and US GAAP on these revenue and lease rule changes?
Okay, US GAAP, the revenue recognition principles are based upon IFRS 15, and IFRS 15 was a joint project with between the International Accounting Standards Board and the FASB in the United States of America. So whilst the standards might be written slightly different, the underlying concepts are pretty much similar under US GAAP and IFRS for revenue recognition, and hence FRS 102. There are some very, very similar sort of underlying principles. There might be some nuances and descriptions in IFRS and US GAAP that are sort of slightly different, but generally the principles are the same. Now, when we look in the world of US GAAP, we look particularly for lessees under US GAAP. This is where, like, the International Accounting Standards Board and the American standard setters didn't sort of see eye to eye, and the Americans wanted a straight line expense for all lease costs that had gone on balance sheet. So one of the key differences between FRS 102 and US GAAP would be on the treatment of depreciation of right of use assets. So for a right of use asset, generally under FRS 102, we will be depreciating that on a straight line basis. And then the interest will be higher in the earlier periods and later in the low periods. So we will have a skewed lease cost higher in the earlier periods and lower towards the end. They didn't like that in America. So what they opted to do instead was, let's have the interest on lease liabilities being recognised, where we've got interest higher in the earlier periods and lower, so the interest profile is similar, but let's calculate our depreciation in a weird sense that it's almost like a balancing figure, just to keep the net lease expense the same year upon year. So that's one of the changes there. There possibly are some other changes, but that's the big difference that I'm aware of.
Thanks, Neil. The next question, can rolling leases that are less than 12 months notice be considered short-term and excluded, even if historically they have been extended?
That is a difficult one, and because they may not actually really just be a lease of 12 months or less. If we're really reasonably certain of exercising those extension options, then it is going to be a longer lease. So can't necessarily avoid it on that basis. We would need to sort of assess, whether that extension option is really likely to take place, and we get also like a similar type of thing where there may not actually be a lease agreement anymore. The lease may have expired, but an entity still continues to occupy the property on an informal basis. And it may be that in those circumstances, you still have a right of use asset and a lease liability because of the intention to stay in that property for a while. But I'm not saying that in all circumstances that wouldn't help. But you would also have to think about like the landlord's intentions as well as the lessee's intentions as well. So it's one of those that as a particular assessment, there are a number of things in the lease accounting that are sort of designed to sort of be anti-avoidance. So, for example, you can't create variable lease payments to take off balance sheet if in substance they're fixed. And again, the likelihood of extending options is a very important factor to consider.
Thank you, Neil. We'll do one last question because I'm conscious of time, and then any other questions that are outstanding will be responded to directly. But we've got a question. Are supplier finance disclosures only required for the entity providing the facility, or is it a requirement for the supplier to disclose the availability of the facility to them?
Okay, so these disclosure requirements are intended for the particular entity that is providing the facility to its suppliers. So they're often described as a reverse factoring. So the crux of this matter is, you know, somebody like Carillion that took on this financing arrangement and didn't disclose it. It's all about that, really. So if we do have a supplier that is using a supplier financing arrangement, they're going to get their, their creditors have been paid effectively. They've received their money, that the liabilities have been discharged. There's no particular sort of disclosure, really, because from the perspective of that supplier, if the arrangement has discharged the liabilities that are due, then the creditor's been settled, it's been de-recognised. If it's a different type of facility, for example, where they're forwarded money and they can use that money for other things, then in those circumstances it might be a different type of arrangement, a bit like an overdraft facility. But generally, we're targeting the actual entity that provides the finance facility for its suppliers.
Excellent. Thank you, Neil. I think we're going to have to close now, but just based on time, but we will draft some answers to the frequently asked questions and share that with
Definitely, we'll create
shortly.
a proper document for that.
Thank you.
So yeah, brilliant. Well, thank you, everybody, and thank you for all of you attending and the time. And I hope you found it useful. This is really a first session. The intention now is to sort of build on this and actually do some more focused ones on revenue and on leases and more detailed aspects of it. It's impossible to do a complete session on this that focuses on every type of industry and every type of accounting scenario. So the next stages will be diving deeper and getting more involved and actually having a deeper sector focus on some of these things as well. So I think finally, I think one of the next things I'll be presenting on will be like the Finance Director Seminar in February 2026. So any of you that dial into that, look forward to seeing you on that. But please keep posted for other seminars that we're going to do in this area. I want to keep the momentum going and sort of, we can all learn together and hopefully some of the sessions that we do sort of help you along the way or provide you a bit of confidence that the projects that you're undertaking are sort of going in the right direction. So, but it's been a real pleasure and look forward to it again. So thank you very much.